So you found your dream home, and now you find yourself asking the question, what is bond cover? And then you really need to have bond cover. Well, in this video, I'm going to be guiding you on those two answers, but I'm also going to be sharing with you 3 secrets in which you can ensure that you're getting the most value for money from the bond cover. So in essence, the best bond cover you can get. So let's go through it. What exactly is bond cover? Now, bond cover is basically a life cover that protects the insurance, not the insurance company, but protects the bank in the event of you being disabled or you passing away. So let's look at what exactly is taking place, right? So you are applying for some finance, you've got a bond, and this is via one of the banks or one of the home loans companies. And let's assume that your bond is R1 million. Now, as long as you are able to pay this bond, the insurance company knows the finance company knows that you'll be able to complete payments. But what happens in the case where you happen to pass away? So if you passed away, or in the case where you are disabled, you're no longer able to continue working, you can't earn an income. So these are instances that are beyond your control. And the bank just wants to make sure, in cases like that, are they able to still receive their money? Because they are trusting you and they are advancing you this money. They just want to have the peace of mind that they're able to get back that money. So in a nutshell, bond cover is just you saying that you're taking some kind of life cover in order to ensure that in the event of something happening to you, that being a death or disability, depending on the type of plan, life cover policy, depending on the kind of plan, that this policy then will then pay out to settle the bank or the finance house that you've taken it with. So that's exactly what bond cover is. Do you need to have it? Well, you want to analyze what would be your reason for not having it. So let's look at it from that perspective. What happens if you don't have bond cover? Well, if you don't have this in place and you happen to pass away or you happen to have a disability, how would you pay for this bond? If you are not in a position to pay for it, do you have someone who can pay for it for you? Now, if you don't have someone to pay for it, then you could find yourself in a position where the bank or the finance house now comes back to say, look, you can't afford to pay for this anymore, so we're taking back the property. Meaning they're going to take away the property or they're going to put the property back on the market for sale. Because remember, they still own that property, so they're putting it on the market for sale. They're going to sell it at whatever price because they're just looking to recover the balance. So let's assume that, use an example, let's assume the balance of this money is that you owe them at the time of a disability or death is 700,000. So notice what happened. You financed for R1 million, but at the time of you having a disability or passing away, you owe 700. Now, the bank's main focus is not making a profit. Their focus is making back the money that is theirs, that you committed to paying them. So they just want to get this out as quickly as possible. They want to sell for to get back their 700,000. Now, if they're in a position to sell for a higher amount, then that difference can then be passed back to you. But the thing is, that's not the bank's intention. See, the intention is not to make a profit. The intention for them is, how do they just get back the money that they lend to you? So it puts you at a risk because suddenly your property might be valued at 1.5 million, see, but they're selling it at a lower price. You're not getting the kind of value that you want. So that is your reason. That should motivate you to taking some kind of bond cover. Excellent. So now that you know what bond cover is, and you have an understanding as to the value of it, so why you need it so much, are you ready to go through 3 secrets that I'm going to share with you in order to make sure that you're getting the most value for money? Good. Let's get started. The first thing that I want to share with you is you can adjust the term of your policy. So you can adjust the term. What this means, you could either finance the policy over a 20-year term. That means if the bond that you are taking runs over 20 years, your life cover policy can have that 20-year time period. See, so this is one way. What's the alternative? Is you finance to what is called whole life. So there's no real term here. It's until you pass away, but we'll call this whole life. That means you keep paying for this policy for as long as you live. What's the difference between the two? In terms of the time period, so when you are using something over a 20-year term, the insurance company now is going to charge you for 20 years. Now, if something happens inside the 20 years, they'll make payment. If nothing happens beyond the 20 years or by the 20th year, the policy can renew itself. You have that option, or the policy can close itself. In which case, there's no more premiums that you'd pay, and then you won't enjoy any cover. Meaning, if you passed away, that's it. There's nothing to pay because the term for the policy came to an end. But why this is beneficial is if you structure your policy in this way, then you're only paying for the term that you need, which means your premiums become a lot less. See, your premiums become a lot less. So from an affordability perspective, having that term becomes beneficial. If you're going to structure this as a whole life policy, meaning it's continuing until such time you pass away. Now, you may pass away after the term of the bond, meaning, let's say, 40 years from now, but you have to still keep paying for this policy, you see, even though your need for the cover has reduced. Now, that's quite a key thing. So at the time that you've settled the bond, let's use an example again. Let's say your bond was R1 million, and you got to year 20, and now you settled it. You paid this bond off in full. Now, going forward, still retaining that cover, you have the life cover, and it is still going to pay out that R1 million. But do you still need it? That's what you want to ask yourself. Because if you don't need it, then you're ending up paying for something that you don't need. See, which could be, and that money could be channeled to something else. So this is the first secret you want to discover or uncover is what term you're going to be using. Is it going to be the term of the bond? Is it going to be until you pass away? So that's the first secret that I want to share with you. The next is in terms of the cover amount, the cover increase, I'll call it that. So what I want you to see is the bond itself might be, again, using the example of R1 million. So the bond itself might be for R1 million. You want to now determine whether you should have that cover to increase or not. Now, technically speaking, if you analyze this very carefully, in the beginning, you owe the R1 million. But when it comes to the end of the term, and I'm going to say year 20, see, this is going to happen. So at the start, this is on day 1, you owe the finance company R1 million. But if the term of the bond is 20 years, so each month you're paying the premium, what's happening? What you owe is now starting to reduce. So when it comes to the 20th year, do you still owe R1 million? No. Possibly you settled out your bond, which then means you want to ask yourself the question, do you want, often insurance company policies are structured with an increase. So it's structured in the opposite way. So they're starting you off with R1 million and it's increasing all the way, which means you could find yourself coming to year 20 and you have a lot of cover that you don't actually need. And a lot of cover means a high premium. So this is another secret you wanna get done well, because over a period of time, the premium is going to escalate. Now, there are 3 ways in which you can structure this. You could either structure this with this way, where the cover is increasing every year. So just like this, it's increasing all the time. You could structure it where you're getting this thing reassessed regularly and you keep reducing your cover, see, because you don't need so much. So you keep reassessing. Or the third way is you could structure this where it's a fixed amount of cover, meaning you're starting off with R1 million, it does not increase. So your premium's not increasing and your cover is not increasing. So that's the way in which you want to analyze it. And naturally, the premium itself changes for each one. So when you're getting quotes, make sure you have a look at the 3 options in order to identify which one's most appropriate for you. And then the last secret that I want to share with you here is in terms of what is called a session. This might sound a bit weird, especially if you're hearing it for the first time, but it's, do you give the bank right of ownership? That's what this means. Do you give the bank right of ownership? Now, usually the banks, again, want to protect themselves, right? So here's the bank here. They want to protect themselves. They want to make sure that this policy is going to pay to them. So here's your life cover policy. And inside it, you've already chosen your beneficiary. So here's the risk from the bank side. What happens if this policy now pays out, your beneficiary takes that money and uses all of it? So the beneficiary spends that money. Now the bank is in a position where they're not able to recover their money. It's going to cost them money to claim against your estate, or cost of getting attorneys involved, cost of if they have to sell the property on your behalf. But it's all sorts of unnecessary costs for them, which they're trying to avoid. So one way for them to avoid this is via what's called a session. So in the session, you are basically giving away the right of ownership to the bank, meaning the bank is first going to take what's due to them. Now let's go use examples. Let's say your policy is R1 million, and initially your bond was for R1 million. But at the time of death, at the time of death, the amount you owe, let's say, is 700,000. Now, what happens in a case like this is when the policy is ceded to the bank, they sort of get the first piece of the pie. So the bank now is going to first take their 700,000, what's due to them, they're going to settle that bond. It's the remaining portion that would go to your beneficiary. See, so in our example, that remaining portion is 300,000. So what happens? The bank first has right of ownership. So remember, even though you have a policy and you have a beneficiary, your beneficiary is not going to gain access to this policy straight away. It's when you do a session. So the bank is first going to make sure that they take what's due to them. The balance of this money, then the insurance company can pay over to your beneficiary. Now, sometimes the bank wants to have this in place. Sometimes they don't. If you find yourself in a position where they want to have this in place, I just want to encourage you to go back and revisit it. So at the time when you settle, so let's just say years down the line, you settle this, and now it's settled, so you now owe zero. Now, if you still have a session in place, you need to make sure you apply pressure on the bank to cancel the session. Because at the time that you pass on, even though you owe zero, the insurance company is first going to go to the bank because it's ceded to the bank. Wait for the bank to tell them what's taking place. And then thereafter, they'll pay the balance over to your beneficiary. Now, if you owe zero, it's just unfortunate that entire delay, because it's a process before the bank actually says, hey, this person owes zero, which means, can you think about your family and how long they would have to wait before they actually receive this money? So if you want to avoid that, then you want to aim to have that session canceled as soon as you settle the bond. Excellent. So now you've uncovered everything that you need to know about bond cover policies, including 3 secrets, and using these secrets well, you can ensure that you're paying the lowest premium possible and getting the most value from this. I'd like to hear from you, from the 3 secrets, which is the one that you feel is going to save you the most amount of money? So comment below and share that with me.